Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas.
And I'm Lana Chen.
Today we're covering a company that most people walk right past on the S&P 500 list. And yet, it's the single largest aerospace and defense company in the world by market cap. We're talking about RTX Corporation, ticker RTX, episode 87.
And here's what makes RTX so fascinating. It's the only major defense prime that also dominates commercial aircraft engines. Lockheed Martin, pure defense. Northrop Grumman, pure defense. Boeing, a mess. But RTX, it straddles both worlds, and right now, both worlds are booming.
$268 billion in backlog. That's not a typo. That's 3 full years of revenue visibility locked in. We're going to unpack how RTX got here, the engine crisis that almost derailed them, and whether this stock still has room to run at nearly $200 a share. So Lana, let's set the stage. RTX Corporation was born in April 2020 through a merger of equals between two legendary American companies. On one side, you had United Technologies, which traces its roots back to 1929 and the Pratt & Whitney aircraft engine business. On the other side, you had Raytheon Company, founded in 1922, the missile and radar powerhouse.
Right. And before that merger closed, United Technologies spun off two massive businesses, Otis Elevator and Carrier, the heating and cooling company. So what remained was the pure aerospace and defense core, Collins Aerospace and Pratt & Whitney, which then merged with Raytheon's defense portfolio.
The combined entity was originally called Raytheon Technologies, but in July 2023 they rebranded to simply RTX Corporation. Headquartered in Arlington, Virginia, right next to the Pentagon, which is fitting. The company employs roughly 190,000 people worldwide.
And as of early 2025, RTX completed its CEO transition. Gregory Hayes, who architected the merger, handed the reins to Christopher Kallio. This is important because Kallio is an operational leader. He came up through Pratt & Whitney, which means the person running RTX right now understands the engine business intimately. That matters, given the challenges we'll discuss.
Today, RTX sits at number 37 in the S&P 500 by weight, about 0.44%. The stock trades around $198, with a market cap of roughly $266 billion. That makes it bigger than Lockheed Martin, bigger than Northrop Grumman, bigger than General Dynamics. The largest aerospace and defense company in the world by market capitalization.
RTX operates through 3 distinct segments, and understanding each one is critical to understanding the investment thesis. Let me walk through them.
Take it away.
First, Collins Aerospace Systems, roughly 34% of revenue, about $28 billion annually. Collins makes avionics, flight controls, nacelles landing gear, cabin interiors, and connectivity systems. They supply components to virtually every commercial aircraft flying today, from the Airbus A320 to the Boeing 787. They're also deeply embedded in military platforms.
And what's key about Collins is the aftermarket business, right?
Exactly. Collins has this incredible recurring revenue stream. Once their parts are on an aircraft, airlines need Collins for maintenance, repair, and overhaul for decades. 45% of Collins's segment growth comes from this high-margin aftermarket business. It's essentially a razor and blade model for aircraft components.
Segment number 2.
Pratt & Whitney, also about 34% of revenue, roughly $28 billion. This is the engine business. They make the geared turbofan, or GTF, engine that powers the Airbus A320neo family, the most popular commercial aircraft in the world. They also make the F-135 engine for the F-35 Joint Strike Fighter. On the commercial side, Pratt operates in a duopoly with GE Aerospace's CFM International. There are only 2 companies in the world that make engines for narrow-body commercial jets, and Pratt & Whitney is one of them.
That duopoly is a huge structural advantage.
It really is. And then the third segment is Raytheon, about 32% of revenue, roughly $27 billion. This is pure defense. Patriot missile systems, Tomahawk cruise missiles, AMRAAM air-to-air missiles, Stinger manpads, advanced radar systems like the Ghost Eye, and cybersecurity solutions. Raytheon is arguably the world's premier missile company.
So to summarize the business model, RTX is a 3-legged stool. Collins gives you commercial aerospace components with sticky aftermarket revenue. Pratt& Whitney gives you engines in a duopoly, and Raytheon gives you defense missiles and radars backed by government contracts. That diversification is what makes RTX unique. All right, Lana, let's dig into the numbers because RTX just posted a monster year. What did fiscal year 2025 look like?
Full year 2025 revenue came in at $88.6 billion, up 10% year over year. That's organic growth across all three segments. Adjusted earnings per share hit $6.29. But the real headline was free cash flow, $7.9 billion, up $3.4 billion versus 2024. That's a massive improvement.
And Q4 was particularly strong.
Q4 was excellent. $24.2 billion in quarterly sales, up 12% year over year, adjusted EPS of $1.55, free cash flow of $3.2 billion in a single quarter. The business is generating serious cash.
What about the 2026 guidance?
Management guided for $92 to $93 billion in revenue, which represents 5 to 6% organic growth, adjusted EPS of $6.60 to $6.80, and free cash flow of $8.25 to $8.75 billion. If they hit the midpoint, that's nearly $9 billion in annual free cash flow. For context, that's enough to fund the dividend, pay down debt, and still have billions left for buybacks or strategic investment.
Now let's talk about the balance sheet. I know RTX carried a lot of debt after the merger.
They did, but they've been aggressive about paying it down. They retired $2.9 billion in long-term debt in late 2025, bringing total debt to about $38 billion. Debt to equity is a healthy 0.63 times. Total assets of $171 billion against total liabilities of about $104 billion. The balance sheet is in good shape, especially given the scale of this company.
And the dividend?
RTX pays a quarterly dividend of 68 cents per share, yielding about 1.4% at current prices. They paid out $2.7 billion in dividends in the first 9 months of 2025 alone. It's not the highest yield in the defense sector. Lockheed Martin yields about 2%, but it's well covered by that nearly $9 billion free cash flow run rate.
Okay, so here's where RTX's story gets really exciting. There are multiple growth engines firing simultaneously. Let's start with the defense backlog, because $268 billion is a staggering number.
It is. RTX ended 2025 with a record $268 billion backlog, up 23% year over year. That breaks down to $107 billion in defense and $161 billion in commercial. The book-to-bill ratio was 1.56 times, meaning for every dollar of revenue RTX delivered, they booked $1.56 in new orders.
And some of the recent contract wins have been enormous.
Enormous is an understatement. In 2025 alone, RTX won a $50 billion umbrella contract from the Defense Logistics Agency for Patriot Systems sustainment over 20 years. Spain awarded them $1.7 billion for 4 Patriot air defense systems. Pratt & Whitney secured a $6.6 billion F-135 production contract for the F-35. And then in February 2026, Raytheon signed 5 landmark framework agreements with the Department of War to dramatically ramp munitions production, over 1,000 Tomahawk missiles per year, 1,900 AMRAAM missiles, and 500 SM-6 interceptors.
That munitions ramp is directly tied to the geopolitical environment, right?
Completely. NATO allies are finally spending toward that 2% of GDP defense target. The war in Ukraine, tensions over Taiwan, escalation in the Middle East, all of this is driving a global defense spending supercycle. And RTX is perfectly positioned because Raytheon makes the missiles that allies are scrambling to stockpile. International defense orders now represent 40% of RTX's defense revenue, up from 30% just 3 years ago.
And on the commercial side, the A320neo production ramp is a huge tailwind.
Absolutely. Airbus was producing the A320neo family at about 55 to 60 aircraft per month in 2025, with plans to reach 75 per month by 2027. Every one of those jets needs either a Pratt & Whitney GTF engine or a CFM LEAP engine. Plus, Collins provides nacelles, avionics, and other components. RTX essentially gets paid twice on every A320neo, once for the engines and once for the airframe systems.
Let's talk about how RTX stacks up against its peers, because this is a really interesting competitive dynamic. Lana, who are the main competitors?
In defense, the big four are RTX, Lockheed Martin, Northrop Grumman, and General Dynamics. Boeing also has a defense segment, but it's struggling. In commercial aerospace engines, the only real competitor is GE Aerospace through the CFM International joint venture with Safran. Let me break down the key differences.
Start with Lockheed.
Lockheed Martin is essentially pure defense. 95% of revenue comes from government contracts. The F-35 HIMARS, Black Hawk helicopters, space systems. Revenue was about $71 billion in 2024 with a trailing PE around 28 to 29 times. Lockheed is stable and predictable, but it has zero commercial aerospace exposure. When defense budgets plateau, Lockheed has nowhere else to grow.
Northrop Grumman.
Also, pure defense. They're building the B-21 Raider stealth bomber, which is incredibly exciting, but incredibly expensive with significant execution risk. Revenue around $41 billion, PE about 23 times. Great company, but again, no commercial diversification.
General Dynamics.
GD is interesting because they have some commercial exposure through their Gulfstream business jets division. But the core is still defense. Combat vehicles, submarines, IT services. Revenue about $48 billion, PE around 23 times.
And Boeing?
Boeing is the cautionary tale. They have both commercial and defense exposure. But the 737 MAX crisis, quality control issues, and a troubled defense division have created years of chaos. They're essentially the version of RTX that went wrong.
So what makes RTX structurally different from all of these?
RTX is the only company at this scale that genuinely benefits from both the defense spending supercycle and the commercial aerospace recovery simultaneously. Lockheed and Northrop only get defense. Boeing is broken. RTX gets both, plus the engine duopoly, plus the Collins aftermarket annuity stream. That's why the market gives RTX a premium valuation.
All right, we need to address the elephant in the room, the GTF engine crisis. Lana, this has been the single biggest headache for RTX over the past few years. Where do things stand?
So in September 2023, Pratt & Whitney disclosed that a rare powder metal defect in GTF high-pressure turbine and compressor discs could cause cracks over time. This affects engines manufactured before the third quarter of 2021, when they fixed the metallurgical process. The financial impact was a $3 to $3.5 billion pre-tax charge.
And the fleet impact has been severe.
Extremely severe. As of late 2025, roughly 835 GTF-powered aircraft were grounded globally. That's about 38% of the entire Airbus A320neo fleet. Engine overhauls that normally take 60 to 90 days have stretched to 250 to 300 days because of the intensive inspections required. RTX has warned that an average of 350 aircraft will remain grounded annually through 2026.
But there is a light at the end of the tunnel.
There is. The GTF Advantage engine received FAA certification in early 2025 and European EASA validation in October 2025, with entry into service in 2026. This redesigned engine has about 35 new parts addressing the durability issues, up to double the time on wing and 4% more thrust. Plus, there's a Hot Section Plus upgrade for existing engines that provides 90 to 95% of the Advantage benefits. Though the solution exists, the question is how fast they can execute.
What other risks should investors watch?
Several. First, tariffs. RTX faced an $850 million tariff headwind in 2025, reduced to $500 million after some reprieve, but the 2026 tariff environment remains uncertain. Second, supply chain. Titanium lead times are still double pre-pandemic levels, and casting supplier capacity is still ramping. Third, there's a new policy risk. In January 2026, President Trump signed an executive order directing the Department of Defense to restrict defense contractors' dividends and buybacks during periods of underperformance. If enforced aggressively, this could limit capital returns to shareholders. And finally, RTX paid nearly $1 billion in regulatory settlements in 2024 for export control and government contracting violations. Compliance and reputational risk is real.
Let's see what Wall Street thinks about RTX. Lana, what's the analyst consensus?
Coverage is broad, with about 27 analysts. The consensus is solidly bullish: 13 buy ratings, 6 holds, and 3 sells. The median price target is $225, which implies roughly 14% upside from the current price of about $198.
Where are the recent upgrades coming from?
After the Q4 earnings report, several firms raised their targets. Citi went to 238, Bank of America and RBC both went to 230. Jefferies and Baird are at 225. JP Morgan is at 215. The overall range spans from a low of about 179 to a high of 240.
What's the bull case from the street?
Bulls point to the defense supercycle, the record backlog providing multi-year visibility, the commercial aerospace recovery, creating a dual growth engine, and improving free cash flow that should approach $9 billion annually. They also highlight the GTF Advantage engine as a margin recovery catalyst for Pratt & Whitney.
And the bear case?
Bears focus on valuation. At 38 times trailing earnings, RTX trades at a significant premium to peers like Lockheed at 29 times and General Dynamics at 23 times. Bears argue that the GTF crisis isn't fully resolved, that supply chain risks could delay the production ramp, and that tariff uncertainty creates margin risk. Some also worry about the buyback restrictions from the executive order limiting shareholder returns. Let's dig deeper into valuation because this is where the debate gets heated. RTX trades at about 38 times trailing earnings and 29 times forward earnings. Compare that to the defense sector average of 23 to 28 times.
So it's clearly at a premium. Is it justified?
I think there's a case for some premium, and here's why. First, RTX has commercial aerospace exposure that pure defense plays don't. That commercial business comes with higher growth potential and stickier aftermarket margins. Second, the engine duopoly with GE Aerospace means Pratt & Whitney has structural pricing power. Third, the backlog provides 3+ years of revenue visibility, which reduces risk. And fourth, free cash flow is accelerating rapidly from $4.5 billion in 2024 to nearly $8 billion in 2025, with guidance for $8.5 to nearly $9 billion in 2026.
But 38 times is still rich.
It is. On a price-to-free cash flow basis, which I think is more relevant for a capital-intensive business like this, RTX trades at roughly 34 times 2025 free cash flow. If they hit the 2026 midpoint of $8.5 billion, that drops to about 31 times. Still elevated, but the growth trajectory is compelling. Revenue growing 5 to 6% organically, with significant operating leverage, means earnings growth should outpace revenue growth.
What about the dividend yield at 1.4%? That's not exactly screaming value.
No, and income investors would do better with Lockheed Martin at 2% or many utilities. But RTX's dividend has room to grow as free cash flow expands. The current payout ratio is very manageable. This is more of a growth and income story than a pure income play.
All right, let's lay out the full bull case for RTX. If you're optimistic about this stock, what's the thesis?
The bull case rests on 5 pillars. First, we are in the early innings of a global defense spending supercycle. NATO countries are rearming, the Middle East is volatile, and great power competition with China is accelerating. RTX's missile and radar portfolio is at the center of this spending wave. That $50 billion DLA umbrella contract and the framework agreements to ramp Tomahawk Hawk and AMRAAM production are just the beginning.
Pillar number 2?
Commercial aerospace recovery is a multi-year tailwind. Airlines are ordering aircraft at record rates. Airbus is ramping A320neo production towards 75 per month. Every aircraft needs Collins components, and many need Pratt & Whitney engines. The aftermarket business alone could add billions in high-margin revenue as fleets age and utilization increases.
Third,
the GTF Advantage engine is a game-changer. Once it enters service in 2026, it doubles time on wing, which dramatically improves airline economics and Pratt's maintenance margins. This transforms the GTF crisis from a liability into a catalyst. Airlines will actually want to upgrade, and Pratt captures that revenue.
Fourth pillar,
free cash flow is on an inflection curve from $4.5 billion to nearly $8 billion to potentially $9 billion. That kind of cash generation funds everything: dividends, debt reduction, R&D, and eventually larger buybacks. the financial flexibility is enormous. And fifth, the AI and autonomy angle is underappreciated. RTX's partnership with Shield AI to integrate autonomous capabilities into weapons systems, combined with Collins's massive commercial data advantage, creates a technology moat that pure defense players can't replicate. The data from millions of commercial flight hours trains algorithms that make military systems smarter. That's a structural edge.
Fair enough. Now let's hear the bear case, because every stock has risks.
The bear case starts with valuation. At 38 times trailing earnings, RTX is priced for perfection. If the commercial recovery slows, if defense budgets plateau, or if the GTF Advantage ramp hits snags, there's meaningful downside. The stock has already appreciated over 60% in the past year. A lot of good news is baked in.
What about execution risk?
The GTF crisis isn't fully behind them. 835 aircraft grounded is still an enormous number. Turnaround times of 250 to 300 days are still unacceptable for airlines. If the Advantage engine deployment faces delays, or if new metallurgical issues emerge, the financial and reputational damage could be severe. This is a real operational risk, not just a financial one.
Supply chain?
Still fragile. Titanium lead times at double pre-pandemic levels, casting constraints, and solid rocket motor bottlenecks could all slow the defense production ramp. RTX has made progress, but we're not back to normal. Any disruption could miss delivery timelines and disappoint customers.
And the policy risks?
The executive order restricting defense contractor buybacks is a real concern. If enforced, it limits one of the key mechanisms for returning value to shareholders. Plus, the tariff environment adds cost uncertainty. RTX estimated $500 million in tariff headwinds for 2025, but the 2026 picture depends on trade policy that could shift at any time. And let's not forget the $1 billion in regulatory fines. While those are largely behind them, any new compliance issues could create headlines and investor anxiety.
So Lana, after everything we've discussed, where do you come down on RTX?
RTX is a truly unique company. There is nothing else like it in the S&P 500. A defense powerhouse combined with a commercial aerospace engine monopoly and an aftermarket annuity machine. The $268 billion backlog provides extraordinary visibility. The defense spending supercycle is real and likely to persist, and the commercial aerospace recovery has years of runway.
But the valuation gives you pause.
It does. At 38 times trailing earnings, you're paying a significant premium to peers. The GTF crisis, while improving, isn't resolved, and new risks like tariffs and buyback restrictions add uncertainty. This isn't a table-pounding cheap stock. It's a premium franchise priced as a premium franchise.
So what's the takeaway for listeners?
For long-term investors who believe in the defense spending supercycle and the commercial aerospace recovery, RTX offers exposure to both themes in a single stock. The backlog provides downside protection, and the free cash flow trajectory is compelling. But given the elevated valuation, I'd suggest patience. A pullback into the 170 to 180 range would offer a much better risk-reward entry point. At current prices, you're not wrong to own it, but you're paying up for quality.
Well said. RTX Corporation, the aerospace and defense hybrid that Wall Street can't stop buying. Episode 87 in the books. That's going to do it for today's episode of Charged Alpha. If you found this deep dive valuable, please subscribe on YouTube, Apple Podcasts, Spotify, or wherever you listen. Leave us a rating and review. It genuinely helps other investors find the show.
And visit us at chargedalpha.com for show notes, charts, and the full transcript of every episode.
Before we go, our standard disclosure. Charged Alpha is produced with the assistance of artificial intelligence tools for research, scripting, and audio production. All financial data is verified against public sources but may contain errors. Nothing you hear on this show constitutes financial advice. Always do your own research and consult with a qualified financial advisor before making investment decisions.
Past performance does not guarantee future results. We may hold positions in the securities discussed.
Thanks for listening. I'm Hudson Thomas.
And I'm Lana Chen.
And this has been Charged Alpha.
Ooh, we do that ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.